Let's start with some of the economic data from last week. The Conference Board Consumer Confidence for May, the prior reading was 97. It was forecast to drop to 95.9, but no way, increased to 102. That is quite impressive. Q1 GDP, not so impressive. However, it was good news for the market, good news for rates, because the economy, especially the consumer, looks weaker than what we expected. Came in at 1.3, exactly as forecast. The advanced look was 1.6. What is more important is how it dropped. What component was revised? And it was the C component, the consumer, which is the one you don't want to see dropping, because the consumer in GDP usually is 65 to 70% of GDP. However, I argue that the consumer is 100% of GDP because whatever other categories are registering, all of that money has to come from the consumer at some point. All taxes come from the consumer. You may say, well, businesses pay taxes only if they're profitable. And they're profitable only if they can sell stuff to consumers for more than what it costs. So the consumers, in essence, are giving the company money to pay their taxes. So all of it comes from the consumer. So the consumer is critically important. The contribution to GDP from our advanced look from the consumer is 1.68, downgraded to 1.34. And it pretty much came from the goods category. Its contribution was negative 0.09 down to negative 0.42. If we look at corporate profits, not good either. The forecast was 3.9% growth. Actually negative 1.7%. That is not healthy. The trade balance was forecasted to shrink a little bit to 91.8 billion and actually grew to 99.4 billion. And inventories, here we're going into April, we're leaving Q1 behind. April retail inventories are up. The previous month they were down, now you have them up. And for wholesale inventories, the forecast was for them to drop a little, but in fact they grew. So you have inventories growing at the wholesale level, inventories growing at the retail level, and out of Q1 seeing a consumer is weaker than expected, all from goods, and you don't inventory services. So whatever we're looking at inventories, those are goods. So inventories are sort of suggesting that what we saw in Q1 is already showing up in the first month of Q2, that you have a consumer that appears to be weakening. If we look at GNI, GDP second look gives us gross national income came in at 1.5 versus the 1.3 on GDP, both still below the 1.6 advance reading that we got, but we do have GNI, our first look, and these are on a real basis. Okay, next day, we had Canadian GDP. Our annualized look at Q1 came in at 1.7. The forecast was for 2.2, lower than expected by quite a bit. The quarter-over-quarter growth rate was 0.4. And with this, we also got our month-over-month for April, which is 0.3, which is a step down in growth. Q1 quarter-over-quarter was 0.4, and we're starting the first month of the second quarter at a lower rate of growth, 0.3. So quarter came in lower than expected, and April coming in at a lower growth rate than the previous quarter. The implicit price deflator, GDP, quarter-over-quarter, negative 0.3. If we head to the U.S. now, look at PCE, look at the month for April, month-over-month, 0.2. The forecast was for 0.3. Everything came in as expected, but there's your surprise, 0.2 instead of 0.3. Personal spending, forecast at 0.3. It was the previous read was downgraded to 0.7, still pretty strong. Forecast to 0.3 is now 0.2. This is consistent with what we saw in Q1 with consumer weakness. We're seeing, again, this is for April, seeing some consumer weakness there with personal spending down, which fits with rising inventories at the wholesale and the retail level. Given what we have with GDP in Canada, we have a Bank of Canada meeting this week, and the odds highly favor a rate cut this week. I'll say more about that coming up. But we do have the U.S. consumer, evidence now that the U.S. consumer is under pressure, not falling apart, still contributing positively to GDP growth, still the big component for GDP growth, even though it's only at 1.3%, but is on a weakening trajectory. All right, let's look at rates and yields. Money market rates, all well behaved, pulling back a little bit, back below the 5.5. Last week it was above 5.5, which I noted was curious, but it's back into an understandable range. Not much happening in the capital market curve, very little change week over week. The curve inversion continues, 683 days on the capital market curve, 566 from the money market to capital market curve, and Canada still more highly inverted than the US. Balance sheet down 4.7 billion. SOMA was down 13.5 billion. So the Fed balance sheet on net increased by about 9 billion. Money market funds increased another 3.8 billion for the week. This is as of May 30th. I'm going to show you something on May 31st. The Friday closing for the S&P just ran straight up in the last 20 minutes. A lot of money came in. So it's hard to tell where that money came from because this is May 30th and this happened the very next day. We'll have to wait till next week to see if money market funds are actually emptying out and heading to equity. I've made the case that we cannot conclude that this money is sitting here waiting to go back into the equity market. Some of it may belong to the equity market, but we can't just say there's 6 trillion on the sidelines, that's why the market should go higher. This whole 6 trillion doesn't belong to the equity market. Retail up almost 2 billion, institutions up almost 2 billion. The only decrease was institutionals in the prime sector, 1.3 billion. FOMC meeting getting closer, 10 days away, June 12th. Odds are almost 100% that nothing is going to happen. Let me close that bracket there. What we're going to get on this meeting is a new SEP. The last SEP, the dot plot, had 3 rate cuts priced in, or not 3 rate cuts, but 3 rate cuts forecast. Will this drop to 2 or will it remain at 3? I tend to think, based on what we've been hearing from FOMC committee members over the last 5-6 weeks, is it probably looks like it's set to drop to 2. Although I still believe there will be more than 2 rate cuts. Also, in the press conference, will we get some indication that July is a live meeting? As we've heard over the last, I'd say, couple of months now. If you go back like 6 months, the conversation was about inflation, that the risks were sort of one-sided with inflation. Then over the last 2-3 months, you've heard that inflation and growth have come into better balance. But more and more, we're starting to hear about concerns about growth. That seems to be starting to become a concern. And if monetary policy works with a lag, if you start cutting rates now, it's not going to affect growth for, 6 months, 12 months. So if you have to forecast out growth in 12 months and inflation in 12 months, I'm sure the committee would be saying, well, inflation will be much lower in 12 months, but if we don't start lowering rates now, growth may even be negative in 12 months. So you have to start playing with the lag. If you're raising rates saying it works with the lag, you have to live with it on the downside saying it works with the lag as well. Big week for central banks this week. FOMC is next week, but we have Bank of Canada rate decision in 3 days at 9:45 a.m. Eastern Time, and the ECB in 4 days at 8:15 a.m. Eastern Time. Both odds are for a cut, heavily in favor of a cut for Bank of Canada. And I don't follow ECB at all, but the consensus here is that they will be introducing their first rate cut this week. So you do have, big central bank events going on here, followed by the FOMC next week. It is a big week for jobs on both sides of the border. Jolts we get in 2 days. The always wrong ADP. Maybe I shouldn't call it the always wrong. The always different ADP. That's been like 20 years. Even go back to 2004, 2005, it was known as the always wrong ADP. But still, it gets reported, and still, it has an effect. And still, by the time we get to Friday, we say, well, ADP was way off, wasn't it? Sometimes they're close, but not enough to suggest that they're, that their numbers mean anything. Because it's the jobs report that means everything. We get that in 3 days. Productivity unit labor costs from Q1 we get in 4 days, and jobs report on both sides of the border we get in 5 days. The Canadian jobs report will come after the Bank of Canada rate decision, but the U.S. number will come before. And I believe we will have CPI, one more CPI before the June 12th FOMC from the U.S. To the end of the year, December 14th, only one rate cut or none has gone from 60.4 down to 55, so 5.4% has pushed towards at least 2 rate cuts, if not more. More than 3, you can call that non-existent at 1%. That's more positioning than anything else. But to have 2 rate cuts, 33.4% up from 31%, this will change things when we get that. Actually, it may not even be that we get there. We may see Bank of Canada go ahead and cut, ECB go ahead and cut. The jobs, if it comes in like less than 175K, that is fairly weak. And if you get CPI that is well behaved, you may actually keep 3 rate cuts in here. And if you keep 3 rate cuts in here, these probabilities are going to shift. Effective federal funds rate 5.33%. Reverse repo up 8.5 billion on the week. It's the end of the month, and it seems rather usually end of month you get an increase in the reverse repo. End of quarter you get a bigger increase, and end of year you really get an increase. But then it drops back down on the first. This is positioning on balance sheets, so this is rather light for an end of month. TGA 716 billion, jiggling around a little bit, up 5 billion. The target here is about 750 billion. Reserves 3.391 trillion, up 16 billion, not much. Excess between the reverse repo and reserves 1.33 trillion at 40 billion a month. Still 3 years away. I think this is going to be a boring thing to watch, like paint dry. I put it in every week simply because I'll put it in, but don't be surprised if 1 week you're watching and it's just not there because it's just not interesting anymore. Not much to see on real yields or break-even rates, moving around just a little bit. Volatility on the long end of the curve seems to be subsiding quite a bit. In most times, the long end of the curve is rather boring to watch. I think we're probably returning to boring, but in front of a rate cutting cycle, it could get interesting. For the Fed funds futures, Q2 is pricing in nothing because, well, you have one central bank meeting before the end of Q2. So other than positioning, call that a 0. Q3, 14.5 basis points, and Q4 another 22 for a total of 37, which is about 1.5 rate cuts versus 3 on the last SEP. So where are we going to be on this one? I still think long end of year Fed fund futures make sense because what's the downside? You may not make money, but I don't think you're going to lose money on this one. TLT down 0.94 on the week. You can see the effect it had, Q1 GDP had. Oh, weak consumer. Okay, well, that's one of the Fed's mandates. That leans more probability to a rate cut. And PCE, okay, well, then inflation doesn't seem to be a concern. It's not increasing. That 0.2 month over month was nice, so up we went. So weak consumer and inflation still coming down, or at least being well behaved, not increasing. There's your effect on TLT. SPX down 0.51 for the week. Some volatility returning in TLT. And if you are selling puts, I still think the 90 and the 89s make sense in terms of generating income with what I believe is very low probability of them being put to you. Mortgage rates back over 7%, 7.03. 10-year Treasury increased 6 basis points. 30-year FRM increased 9, so the spread increased by 3, sitting at 252. This is interesting. Housing Price Index for March came in at 423.4, an all-time high. Case-Shiller for March up 1.6% month over month, up 7.4% year over year. The index is sitting at 316.646, all-time high. Not only are markets hitting all-time highs, not only were some commodities hitting all-time highs, now housing pricing in the U.S. is hitting all-time highs. Isn't that incredible? Look at that 30-year fixed rate, 7.03. And look at your housing indexes at all-time highs. Mortgage apps for May, week ending May 24, down 5.7. Pending home sales for April, down 7.7%. OASs continue to look the other way, saying nothing to see here at all, and really, this is just as boring as well. It used to have a whole page. If you go back like a year, there was a whole page dedicated to credit spreads, and then now it's got, like, poor little guy, it's got like 1/8 of a screen on screen 4. It's like your story being hidden on page 12 in 4 lines in the New York Times, and you think, but I thought I was really important. It's just not important right now. Maybe it will be. We get vehicle sales this week. This is going to be interesting. A total vehicle sales for May we get in 2 days, and then of course you're going to have the vehicle manufacturers reporting their monthly sales as well. Used car prices we get in 5 days. I expect that to be soft, only because we are now running somewhere around a 15.8 million seasonally adjusted annual rate in terms of vehicles in the U.S. 15.8 to 16 million, depending on the source you're looking at. That should put downward pressure on used car prices. Let's look at some new positions. Now, yesterday I put out a video for the applied level talking about new subscriptions coming up, and starting September that I will be reporting my new positions in far more detail than I do here. So I've tacked that video on to the end of this one in case you didn't see it. So after the market outlook is over, that is tacked on to the end. You can continue watching. I will be talking about my new positions for a while, but starting September 1st, I will not talk about my new positions in the market outlook. They will only be within the subscription. Let's look at some of the new positions. Oxy, the July 60 puts I sold at $1.33. OPEC Plus was going to be meeting on the weekend, and I felt that they're not going to raise production. I think they are looking for a floor price on oil, and I think they'll slowly walk that floor price up over time. Their supply is, I would say, limited because the shift to EV will continue. Regulatory moves are almost forcing it to happen over time. I don't think it's going to happen by 2035, but it's going to happen. So that means that the amount of oil that they have at this point in time, if they're going to maximize the value of it and extend the life of it, they gotta keep production down. So it wouldn't have been a surprise if they would have extended their cuts into the foreseeable future, and that is what they did. Cuts extended through 2025. That will give, I don't know if it'll give a boost to oil prices, but that will put a floor on oil prices, so I feel good with the Oxy $60 puts. Consolidation continues in the Permian Basin, and with consolidation continuing, Oxy may be a takeout target for someone at some point, even Berkshire. So I am comfortable with the $60 puts, and if I own Oxy under 60, I am comfortable at that. On Semi, sold the 65 puts for $1.64 for July. Nice implied volatility here. Nice premium in there. They make silicon carbide chips, which means that they can make a substrate that's instead of it's like a third the size, which reduces the weight of the chip and works effectively for heat dissipation. And they have 68% market share in advanced driver systems for vehicles. So if you think that ADAS is going to increase in more vehicles, they got a 68% market share there. Their first quarter earnings were good. Margins and growth year over year were light, but quarter over quarter Q1 was nice. So I don't mind owning on semi below 65. I get $1.64 for that. So if it's put to me, my average price would be 63.36. I'm comfortable with that. IYR, the REIT, the July 79 put at 63 cents. Given that rates are probably at their peak, given that commercial real estate is probably at its depth, and you're getting a lot of return to work mandates, not just from companies, but certain municipalities are instituting the return to work because they're recognizing that the lack of office workers is actually hurting revenues in terms of the revenues that they can raise for the municipality. So even municipal workers are being ordered back to work, offices, companies with offices, back to work mandates. And I think the work from home really was just, the big increase was a passing fad. I've felt that way for quite some time, but it just lingered and lingered. I think work from home companies are not going to be as competitive or as productive as those that are in one location. So I sold the 79 puts on this. Somebody had mentioned office, and I think if you're going into office, you want to be in Class A properties in gateway cities. Don't mess around with secondary cities. Don't mess around with Class B. I just don't know that market is there just yet. But if you're going to ride the rate cut cycle in commercial real estate, it's got to be Class A properties. Boston Properties, BXP, somebody had mentioned that. That is a good one. They have Class A properties in gateway cities. Very low price right now. I think they're in the 50s, 55 to 60 range. I didn't want to pick on any one particular name, so I just chose the index itself, the IYR. I do expect Canada to cut rates on Wednesday. And if they cut rates, the Canadian apartment REITs should get a lift for two reasons. On the expense side, their interest rate expense will decrease. And on the asset side, the investment property listed on the balance sheet, fair value should increase because you have net operating income over R minus G. I don't think you're going to change the G with a drop in interest rates. We have a shortage of housing in Canada. The NOI is continuing to grow at a nice G, but the R will drop, which means the cap rate will drop, which means the property value will increase. Canada uses IFRS, so investment properties are listed at fair value. You'd be looking at fair value gains on the balance sheet, which show up in earnings in the EPS number. So I added to my InterRent position. I added at 11.90, at 11.75, and 11.58. You never know where the bottom is, so you add on the way down. I added Minto at 14.65 and at 14.50. I added more cap rate at 43.02. I was very happy that it retreated, even though my portfolio value kept going down associated with that position. It's a very big position. I did say I would have liked to have seen this at 41, 40, even 39, I would have loaded up. So I added more at 43.02 plus when it was down there, I sold 43 puts at $1.09. I now have 500 puts on cap rate laddered from the 43, the 44, the 45, and the 46, with 300 of them alone at the 46. Killam, new positions here, added at 17.16, 17.07, and 16.89. I am comfortable holding the apartment REITs simply because of the structural housing shortage that we have in Canada, the high occupancy rates, and the high NOI growth that they're still pulling off. If you have your rate cutting cycle with all of that other stuff going on, they are natural winners. So I don't mind holding them for that. The other reason is I get my rent check on the 15th of every month. I get dividends out of these. I get it on the 15th of every month. I'm comfortable with that. What is going on with AT&T? Look at these last 2 days, Thursday and Friday. Huge price gains, especially on a company as big as AT&T. 52-week high closing as of Friday at 1816, a 52-week high. I had puts on AT&T. I had $17 puts on AT&T, and I had $16 puts. And given the big run up over 2 days, I felt, nah, that seems a little overdone. So I decided to close my puts. I closed the 17 puts at 15 cents. I had got them for 40 cents. I only had 50 of those. And I closed my 18 puts for 46 cents. I had gotten 99 cents, and I only had 30 of those. And they were open for less than 2 weeks, so it was a nice quick gain. I did not expect AT&T to move that way. I did expect it over time to slowly move up from 17, and at some point it would hit 18, then 19, but I thought that would correspond more with quarterly events. Here was Q1 earnings. Their next earnings, Q2, is July 24th, so we're at the 18. I haven't decided whether I want to move my strike to the 18 at this point. If I did want to move my strike to the 18, I probably would have left these open, but I just felt that that was a little too much. And I've said this before, when the market gives you something really fast, take it. Just take it. Even if there's still some money to be earned on it. If the market gives you something that fast, you just take it. I don't know if 18 will be the new strike where I'm going to sell. I need to see the behavior of AT&T for a while to figure out if 18 makes sense to be the new strike. Or it could continue to run and go to 19. I looked around for news of why over those 2 days it was having that kind of behavior, and I could find no news on AT&T. So, you know, it's sort of the general story, right? They are one of the networks. So if you believe in a mobility future and a connectivity future, the Internet of Things and autonomous vehicles, you need the network. You need the backbone. You need the network, period. So I think both AT&T and Verizon are going to be good winners here, with AT&T offering, in terms of the percentage of margin that the premium provides, AT&T is superior on that one. And I think that on a going forward basis, their execution plan of what they plan to do and how they're doing it, I think is superior to Verizon's as well. So where am I with AT&T right now? Well, I am out. I've made, I've sold 16s, 17s, and 18s now for quite some time, and I've made some good money on all of them. And I just have to figure out now, is AT&T going to use $18 as an attractor point, or are we going to get a retracement back down into this range that we've had for the last year? The last time it ran up, it ran down fairly quickly. So let's see what happens over time. I'm just on the sidelines. It's still on my watch list, but I have no position, nor do I have a plan for it yet until I see where it wants to go. Okay, let's have a look at copper and gold. Copper doing what I thought it would do, kind of retreating a little bit, down 3.91% week over week, sitting at 4.65. Would not surprise me if this got down to maybe even as low as 420. I'm not calling for 420. I would not short copper at all. At all would I short it in any way whatsoever. But it would not surprise me if it got to 420. If it got to 420, I'd probably, on the contract on HG, sell $4 puts. I'm going to show you how you can look up the level of stocks at the CME shortly. Gold down ever so slightly week over week. It was pretty much unchanged, by the time you got into PCE, and then PCE came out, and throughout the day, gold retreated from, let's say, 23.65 prior to it to 23.47, about 18 bucks down, but still negative 0.52 on gold. Let me show you where you can find inventory levels on a daily basis for the CME. Okay, here we are. The link to this is in the description box below. It'll bring you right to this page, and right down here you have warehouse and depository stocks. You have gold, gold kilo, silver, copper, platinum and palladium, aluminum, zinc and lead. If you click on copper stocks, a spreadsheet will download, and I will drag the spreadsheet onto the screen here to show you what it looks like. I think that we can probably increase this a little bit. So it gives you the delivery point. We have Baltimore, Detroit, El Paso, New Orleans, Owensboro, Salt Lake City, and Tucson, or as some of you like to call it, Tucson. And the previous total, how much was received, how much was withdrawn, the net change, the adjustment, and the total. This is for May 31st only. Total copper stocks were 17,476 short tons. And we had withdrawals of 869 short tons, so inventory at the end of that day decreased to 16.6. And you can download this every day, and it's 1 day behind. So this is this was the Thursday change. Notice the activity date was 5:30. We get it the next day at 5:31. So it can help you make sense of where you're seeing copper going. So if we start seeing, like, look at all the zeros in here in terms of received. Once you start seeing numbers showing up here and inventories building, that is going to put downward pressure on the COMEX contract. And that's probably what would bring it down to 420. So every day on Monday, it is worth going to the CME and looking at the spreadsheet and seeing, well, what happened on Friday? Because Friday we had the price that was a little bit under pressure. Were there deliveries that were happening over the course of Friday? Did inventories increase? And if we're seeing inventories just decreasing and decreasing and the price of the contract is soft, I think you can get a little bit more bullish on that contract. Again, for this page, the link is in the description box below. Okay, let's have a look at the Friday closing for SPY. Super interesting activity here. I usually watch the closing, watch my positions just to see what is going on into the closing each week. And I just saw volume coming in, and everything, not everything, but half the things that I watch going up, other half kind of going sideways. The market really going up. So here's the closing where the dashed line is on this little green bar. That is 3:40 p.m. We had a closing price at 3:40 of 522.29. By the time we got to 4 p.m., the closing price at 4 p.m. was 527.93. That is a 1.02% increase in SPY in 20 minutes. In just 20 minutes, the last 20 minutes of the week. Volume leading up to that was light, less than 500,000. Here you had like 250, 280,000, 300,000. You had maybe 400,000 or 500,000 here, but it was light. Then you get a jump to 1.3 million for the next 5 minutes, and 1.6 and 5.2. Then from 350 to 355, 11.3 million, and in the last 5 minutes followed up with another 3.7 million. That is huge volume. So you had price and volume. You have price moving up on volume moving up. Technical analysts would say they confirm each other. We can believe that move. That is interesting. So I start looking around on the weekend at other stock charts to say, how many stock charts displayed this pattern? Was this money entering the market in a whole bunch of passive vehicles and everything was just going up? And no. Commodity related stocks didn't really display this pattern. AT&T really didn't display this pattern. It went up, I think, like 10 cents or 11 cents during that period of time, but it was up strong all day long, so you couldn't really tear it apart. Some of the other stocks I watched didn't really display this pattern. They were mixed. But what did display this pattern were Canadian REITs. They rose up into in those last 20 minutes, which seemed odd. That's Canada. That's not the U.S. The IYR, same thing. Utilities, same thing. So I start looking around and say, you know what? It's a lot of interest rate sectors. So it could be that a lot of money came into the market based on some large fund or fund somewhere saying, okay, now is the beginning of the cutting cycle. The belief that Bank of Canada and ECB are really going to set the tone next week and start cutting. And we are at the beginning of the significant G7 rate cutting cycle. That could be it. I don't know. I just find 1.2% move in the final 20 minutes on no headlines. I looked around for headlines. I couldn't find headlines. So this is not a mistake. I don't think it's a lot of short covering that happened. Although if you were short, you probably got caught up in some of this. You probably triggered some stops on some shorts going into the weekend. But this looks like it was money being committed. Can't tell from money market mutual funds assets because we don't have it as of Friday. So I guess we're just going to have to wait to see what happens. What is it? As I do this now, it's Sunday at 11. I think it's raining. I can hear the rain. Costa Rica, it's raining. It doesn't say much. You can say that every single day. I think it's raining. We're in the rainy season, so here we are. This bears watching. I don't know what to make of this. I want to see how Globex opens Sunday night. It is 11 a.m. Eastern time where I'm sitting. Globex opens at 6 p.m., so we've got 7 hours to see if the market will open, the futures will open and maintain this, or if this was money coming in very late in the day that did not have enough sellers left in the market that day. So any volume pushed that up. Okay, let's have a look at SPY in general. Still all-time high is 531.40. We're not there. 528.03. We haven't seen it this week. Forward four-quarter operating earnings from LSEG 252.89, up slightly from the last week. SPGlobal 249.84. I don't think they updated their spreadsheet because when I looked at the earnings upcoming this week, there was nothing. We're slipping here, Mr. Silverblatt. We're slipping. So you got to get back to work. If you're working from home, get back in the office. The blended of the two, the average of the two, given the closing SPX forward multiple of basically, call that 21 versus 21.12. Surprise factor still sitting at 8.1%. So if that continues on, that's really a forward multiple of 19.5. Implied volatility, some of it coming back, 33% on the 13-week versus 15%. And you do have some companies reporting this week. Nothing much to talk about overall. I don't think they're market moving. I think the big market moving events this week are the ISMs, all of the jobs data, and the two big central banks. I say two big central banks because they're G7 quality. LSEG says 8 are reporting. Sectorspdr.com says there are 6. When there are so few and you still can't get it right, I don't know. I think there's a business model here in developing a calendar that people subscribe to for, I don't know, $1.50 a quarter, $6 a year, where you just get it right, Is anybody else, is anyone else, looking at this saying, oh, come on now. You guys are big data providers that you charge thousands of dollars a year for, and you can't get this right? I can't get over it. I honestly can't get over it. Unless, of course, all of the data analysis is done in the US and Canada and maybe in Japan. And the calendar is done in Costa Rica. And if you are in Costa Rica, you'll understand exactly what that means. Anyways, that's it for the week. What follows is the video I put up yesterday about the applied level. New content that has been put up, new content you should expect this week. The Fed balance sheet will be up on Tuesday. Changes to the applied level subscription that will be coming up as well. So if you haven't seen that, that is on the tail end of this. If you have seen that, that is it for this week. The big theme this week, the big theme by far is U.S. economic data to see if the Fed is going to be pulled more towards that, and two central bank announcements, two big market movers, I think. If you get a rate cut out of Canada and the ECB, and you get data out of the U.S. that suggests that the Fed should be paying attention to the economy, maybe that big rush of money into the S&P last week and into interest rate sensitive sectors knew something. I'm going to update you on where we are with the applied level. We have some content updates, some stuff that's out, new stuff coming out. Then there's an update to the subscriptions. And I will describe a new module that starts September 1st called New Positions. Right at the very end, if you're not sure or you don't know what the applied level is, right at the very end, I'll go through a description of what the applied level is and where you can find a PDF that describes it more. I won't start with that because many of you watching already know what the applied level is. So let's look at some content updates. Understanding automotive OEMs, that is now up on the site. So if you are subscribed to our X feed or Instagram, or you saw it on LinkedIn, you would have had noticed that there was a new addition to the applied level. Tuesday, June 24th, the Fed's balance sheet will be posted. I described the balance sheet and pretty much just the big accounts. For example, assets, there's 4 accounts that make up 99% of the assets, and then there's a whole bunch of smaller accounts. I'm not going to bore you with all the details of and they're more like technical accounts. I'm not going to bore you with the details of that, just the big accounts. Then I'm going to show you a whole bunch of transaction entries so you can understand how the whole system changes. Because as you go through the system, you have the Fed, you have the Treasury, you have the banking sector, and then you have the public sector. And in some of these transactions, something changes in all of them. So we're going to look at the Fed buying assets from the Treasury, from the banking sector, from the public sector. I'm going to look at what happens when the Fed sells assets to the Treasury, to the banking sector, to the public sector. The buying is quantitative easing, the selling is quantitative tightening. We'll look at how it works when the Fed reinvests the proceeds from maturing bonds, and how it works when the Fed allows the balance sheet to run off, what accounts are affected. We'll look at what happens when funds and banks use the Fed repo facility, and we'll look at what happens when money market funds use the Fed's overnight reverse repo facility. So that'll be up Tuesday, June the 4th. Lots of transactions, but in doing the transactions, you'll see how the Fed changes its balance sheet. And when it changes its balance sheet, it's doing one thing and one thing only. It is targeting the level of reserves. So we'll see how all of these transactions affect the level of reserves. Live sessions. The last Sunday of every month, I had scheduled 2 Vimeo sessions. But the attendance at these sessions really low, almost to the point of not doing them. That it wasn't very effective considering the subscription count we have. The number of people showing up sort of indicated that, well, it's not convenient for people. So I've canceled the live sessions. You can leave questions. Every video has a comment section. Leave questions under every video. I check the unanswered comments every day. I have a feature where I just click unanswered comments and I can see where the new comments are and just answer those directly. So go ahead and leave your questions there if you have them. Other than that, every Sunday night I do a live YouTube stream at 7:15 p.m. Eastern Time. If you're not sure Eastern Time, it's New York time, or if you're in Canada, it's Toronto time. But I do a live feed on YouTube at 7:15 p.m., which combines the market outlook, questions from the market outlook, and any questions you may have from the applied level. I can answer it there, or you have the comments section under every video. So there's content updates. Let's look at subscription updates. Okay, some changes to our applied level subscription. Let me explain to you how it is set up right now so that you can see the differences. We have two ways to get the applied level. The first way is you are a CFA candidate on our site. You're subscribing to our CFA course. You'll see an option for CFA Plus. The CFA Plus has the applied level within it. And the implied price, if you look at what the CFA subscription costs, the implied price for the applied level is an incremental $320 US. If you just buy the applied level on its own, it is $440. So it is beneficial if you are a CFA candidate on our site to include the applied level because it's $120 cheaper. Starting July 1st for new applied level subscribers who have at least passed level 1, we will offer it for $320, which means you don't have to be a CFA candidate on our site. As long as you're a CFA candidate anywhere, we will extend the price to you for $320, which means you've passed at least level 1, maybe you've passed level 2, maybe you passed level 3, or you're a full charter holder. We will extend this pricing to you. Documents are required to demonstrate that you've at least passed level 1, which is not asking much. If you subscribe on our site to any CFA course, you must demonstrate that you are in fact a CFA candidate. More and more providers out there are beginning to do that, because this is serious stuff, right? You got to demonstrate that you are in fact actually a CFA candidate to access the content. So this starts July 1st. $320. We will extend it to anybody that is at least past level 1. That is, we had to figure out some cutoff somewhere, and it just made sense to say, look, you've at least passed level 1. We know you're a serious person, so let's do that. That does not mean that we're only restricting it to CFA. You can still access the applied level for $440. It's just if you've put in the time, you put in the effort, you've done some work on level 1, we will reward you with a $120 lower price. July 31st is the end of the one price subscription. One price subscription means that if you pay $440 or $320, here's the timeline, it goes on forever. There is no expiration to this subscription, no expiration, and there is no recurring fee, which means no matter what content I add, you get it. That ends July 31st. Anybody who is a subscriber by midnight of July 31st will be grandfathered in, meaning that you will see no changes. That as I add new content, you'll always get that new content. You'll never see a difference. You'll be grandfathered in. Starting August 1st, any new subscriber will get everything I add to the applied level except any module that has a recurring fee to it. And I'll explain a couple that we're doing down here. September 1st, the first module with a recurring fee we're putting up is new positions. That means every Sunday I'll put out a video, and I'll explain what new positions is on the other screen, so maybe I'll wait for that. But new positions, it's $50 a month, which works out to $11.53 a week, and we'll see shortly what you get for $11.53 a week. If you are a subscriber to the applied level by midnight of July 31st, this does not apply to you. That price would not, you get it. You get everything in perpetuity. But starting August 1st, if you want access to new positions that comes out September 1st, you would have to subscribe to it as an add-on module. That's going to happen in September. Then there's the midterm and long-term. Midterm is like 1 to 3 year period. In the 1 to 3 year period, we'll be introducing industry peer groups, and that is $25 a month. So, for example, and I'm just going to make this up here. In Canada, there are 6 publicly traded apartment REITs. So what the peer group would be a description of each of the 6 companies and an evaluation of them, because every company sits in one of 3 buckets: sell, hold, or buy. If something is a buy, you buy it. If something is a hold, you sell puts. If something is a sell, you sell calls. There's always a trading strategy on everything. So I will list the 6. Anything that has options, obviously there's a play on. And every quarter, I will update them. Every quarter, I would update them. And every week, there'd be about a 10 to 15 minute video talking about the sector and what is affecting the sector that week, any news on any of the companies, anything that is significant. So it's like having a mini analyst for that little subsector. And then it's just a matter of finding other sectors to do. So if we found a good analyst that understood automotive retail, auto retail, for example, there are 6 publicly traded retail groups. AutoNation, Lithium Motors, Penske, Group 1, I forget the other 2 names, but there are 6. It would be the same thing. If we get to something like junior miners, there are literally dozens of companies. You can't possibly follow them all. So whatever analyst we have for junior companies would pick 5 to 10 of the more significant ones, and we would follow those. And all of those set up different trading strategies because, again, they either sit into a sell, a hold, or a buy. Well, each industry group that you want access to would cost $25 a month because I got to hire an analyst, and I can't hire a rookie. You got to hire somebody that's got 4 or 5 years experience in that particular sector, and they don't come cheap. So you can't keep doing it for one price. But again, if you are a subscriber by July 31st at midnight, none of this applies to you. Any industry group that goes up, you would just get access to automatically. In the long term, we're looking at developing a sector analyst designation. So you know CFA is broken down at level 1 into 10 different sections. This would be broken down into 11. It would be one exam broken down into 11 sections, one for each section of the economy. Each section, reading 1, would be the sector overview. And then you have a number of readings for each of the sub-industries, or at least the significant sub-industries within that sector. And each sub-industry would be developed around one particular case study, one particular company. And you usually pick the largest company in a sub-industry because the largest company usually is the most complex company. And if you can understand the large company, smaller companies tend to be pure plays. You'll easily understand the smaller companies. So the case studies will be built around that, and there'll be 11 sections of this level, each section around a sector of the economy, and each sector will have a number of readings depending on the sub-industries that are important. This is more long-term. When I say long-term, somewhere in the next 3 to 5 years, because there's a lot that has to be done, but looking at developing a sector analyst designation. So just to recap, to make sure you know what's going on, if you are a current applied level subscriber, none of this applies to you. You'll continue to get access unrestricted to anything I put out there. If you are an applied level subscriber by July 31st, you also get that. Starting August 1st, you'll get everything I put in the applied level, but you're not going to get any of the new modules that I add on. Those you would have a fee per month for. Let's look at what new positions are so we can determine whether or not you think that's worth $11.53 a week if you were going to subscribe August 1st onwards. So this new module for new positions is going to start September 1st. And every weekend, whether it be Saturday or Sunday, I'm not sure when I'll post the video, and it'll be just on markmeldrum.com. You'll have to have access to the applied level, and if you are not a subscriber by July 31st, you'll actually have to subscribe to this module to get this. Each week, I will be posting the positions that I'll be taking in the coming week, and my positions aren't just new positions. There'll be new positions, any plans on adding to any existing positions, and any plans that I have on closing any positions. And just so that you are aware of how my thinking is, a lot of my positions are if. If there's market weakness in a particular sector, then I will do X or I will do Y. So if the market pulls back on this report, I would be looking at doing this. If the market is strong and it passes this level, or if a stock passes this price level, I'll be looking maybe at reducing my position or adding to my position. So it's a lot of if-thens. But I'll lay out exactly what I'll be doing in terms of what it is that I'm looking at, what the target security is, why I'm doing it. So a good fundamental reason why I think that what I'm about to do makes sense, and the strategy that I'll be using. That is the how and the when. So I might say I'm looking at ABC. I'm looking at it because of maybe some valuation issues, or maybe there is some fundamental news that changes the future of the company. And then I might say for how and when, I'm looking at selling a put. I'm going to look for a delta around 0.7, which means there's a high probability that this will be put to me, so I'm looking at building a position. I might say, well, I'm looking for a delta of around 0.3, which means I don't mind it being put to me, but I'm looking at this more as an income trade in the short term. So I'll tell you that I'll be selling a put, for example, that the delta will be 0.7. I'll tell you what strike price I'm looking at. I'll tell you days to expiration that I'll be looking at, and probably a price, like let's say if I can get that at 220, I want a strike price of 40. I want expiration anywhere from 30 to 50 days. If I get 220, which is usually, I target anywhere from about 4.5% on upwards as a percentage of margin. I'll lay the whole thing out of exactly what I'm looking to do. At the beginning of the week, I usually have plans of half a dozen to a dozen things I'm going to do in the form of if-then statements. Some weeks, I don't get any of the ifs. Other weeks, I get some of the ifs, so that if I'm looking at 10 things for the week, 4 of them might actually make sense to me during the week. 4 came into the price range that I want, and I took them. But you will have all of the rules. You'll have what it is I'm looking at, why I'm looking at it, and the strategy of how for any new positions, any time that I'll be adding to a position, and any time that I'll be closing a position. If you have watched my market outlook for the last 2 years, I have done a lot of this stuff where I've laid out positions that I would be taking. If you review them, you'll see that I have a very good track record of being right. Not 100%, but nobody in this game has a 100% track record. But I'm very careful. I don't try to come up with 10 ideas every week or 20 ideas. Some weeks, there are no new ideas. Some weeks, my ideas are the same as the ideas I had last week that I didn't get. That the if never showed up, so then I say, well, okay, well, next week, if the if shows up, then I'll be willing to do it. You don't have to swing at every pitch, right? You have all the time in the world to wait for the perfect pitches. It's kind of what I do, so that my hit ratio is very high. So if you see me and you say, hey, if I give this guy $11.53, will he tell me 6 to 10 things that he's doing this week? And if you think that that is worth it, that is exactly what this is going to be. If you are a subscriber by July 31st, you are grandfathered in, you get this as part of your subscription. Starting August 1st, you don't get this module on September 1st. You would then have to purposely subscribe to this module. And that's it. Now I'm going to, for those of you who don't know what the applied level is, you can stick around. I will show you where you can get a PDF that then explains exactly what the applied level is. And in case you haven't seen it yet, or you haven't figured it out yet, CFA has 3 levels: level 1, level 2, and level 3. Level 1 and level 2 are textbook. Everything in level 1 and level 2 is stuff you can find in almost any finance textbook, any economics textbook, any quantitative methods or statistics textbook. Level 1 and level 2 are very textbooky. Level 3 has some applied stuff. You start to get some real world stuff in level 3, but very, very little. The applied level is nothing but the real world. There is no textbook for this at all. when I develop the sector studies designation, it will be the first textbook that is purely applied. And watch this. Level 1 CFA, Level 2 CFA, Level 3 CFA. All right, so you're on markmeldrum.com, and across the top you'll see Home, CFA, FRM. Click on Applied Level and you'll get this screen. And if you scroll down here, view a detailed course description here. You have English, French, and Mandarin. So if you click on English, it will give you a description of exactly what's in the applied level. It'll tell say a little discussion about what it's about. Then your modules, your applied options. You'll cover basic strategies, income strategies, directional, volatility, risk management strategies, and options on futures. So key concepts: selected outcomes, create an income factory, minimize or avoid a loss, sell higher or buy lower than the market price, replicate a stock to avoid forex exposure, and so on. The next module are sector studies. You have all of the sectors here, a description of every sector and the economic drivers of every sector, and within each sector, some discussion of some of the sub-industries within the sector. So here's a screenshot from the first screen of the Understanding Mining video. Up here is a screenshot from the video Understanding Electric Utilities. And as I said at the beginning of this video, the Understanding Automotive OEMs video is up. Notes here, with 163 sub-industries, new content will be added for years to come. Then we have portfolio construction and management. I will be adding more to this module this fall as well. So a bunch of different strategies that you'll learn, examples of trades that will be explored, buy and hold with active management, theta allocation. In other words, how do you set up an income factory for Forex, trading with spot and with futures. We'll look at some curve trades if you're into fixed income, equity market neutral strategies using equities or options, momentum trading, allocation strategies, which can be algorithmic. Usually there is some algorithm that you decide on, whether you actually automate it or not, depends on your trading platform. And portfolio risk management, how you can create synthetic cash, and how you can, if you have cash, how you can turn it into equity without actually buying any equities. Hedging and loss minimization or nullification. So there's a whole bunch of strategies in there, and I'll be adding more this fall. The big one, in my opinion, is the sector studies. If you're going to be a well-versed retail trader, leaning more towards hedge fund style strategies, you have to understand the industry you're trading. And like I say, every stock is a hold, a buy, or a sell. There is a trade on every stock you look at, but you have to understand the sub-industry that it's in. I don't want to say the industry because the industry is a higher level term. The sub-industry is the lowest level that you'll get for a particular peer group, and there are 163 of them. And as I said on the previous screen, there is no textbook for this because this is an addition. It's meant to be and designed to be an addition to your CFA studies. The CFA will give you a lot of information and a lot of knowledge that is relevant in the finance industry from a textbook. And when we look at textbooks, there's a lot of stuff in there that's theoretical. Some of the stuff actually does work, and some of the stuff is used in the real world. CFA does a good job of finding and collecting together those things in textbooks that are useful in the real world, but it's still not real world. This is a whole new level, an applied level, of which there is no textbook that exists. This will be the textbook. This in combination with a CFA designation creates an amazing sector analyst. And that is it. You can read the PDF at your leisure in either English, French, or Mandarin.